We've got that number coming out in just a little bit here. We'll see how it impacts charts like gold, like the indices this morning. Take a look at the dollar as well. We've got yields creeping higher here in the pre-market. Pre-market as in pre-US stock market opening up. Yields are on the rise here a little bit this morning. You've got the dollar index probably popping up just a little bit here. Yeah, I mean, look at this dollar, guys. The dollar index, despite the odds, against the odds, actually broke out of this level of resistance last week. And from a price action standpoint, you got to respect that. That's a pretty big reversal that happened midweek last week. And not only did it reverse, but it actually broke through decisively. Well, it did break out decisively, but you see there's a long wick on the top. I don't love that, but that could just be an indicator that we may see this and then a continued push on the dollar. Right now, from a price action perspective, it's hard to deny the dollar looks pretty dang strong. But again, we will have to see with these economic figures we're going to get this morning, that could sway things one way or the other. The VIX is also up slightly here, 3% this morning. Silver just kind of moderately pulling back. I still like this setup a lot for silver to the upside. I think that this chart looks so good. It's consolidating here near this low. I think that that's a positive here for a potential reversal to the upside. I really like the gold and silver setup right now. Unless, and I'll talk on gold for a moment, I still have my long position on gold from last week. And I've got my stop loss below here. I have not moved it. If we break through the lows, it's time for me to cut the trade and say goodbye. But if we're able to, kind of round out and continue to bottom out around this 2300 level, I'm going to hang on to it. So I have a pretty, gold's got to make a decision here pretty soon, one way or the other for me, because I am willing to hold gold through this consolidation period because I think gold has more upside in the coming, months. If I'm right about that, then great, I will manage the trade, but I could be wrong. When you watch my videos or my live streams, please understand, I don't have a crystal ball here, right? So when I'm making a decision about whether I think something is going up or down, it's not a line in the sand. I'm going to risk my entire life on whether or not I'm right or wrong, right? I'm risking appropriately, and I'm saying, okay, look, if gold can find support here and continue to hold support, it seems to be giving it a good shot right now. But if it can't hold here, if it fails to do so at the end of the day, I need to cut my trade and just move out of the way, because gold from there, if we break these levels, gold could very quickly make a move back down to like 2200. What would get it to do that? Probably rate cuts getting pushed out until 2025. That'd be my opinion. If you're going to see gold get back down to 2200 right now, probably the fundamental catalyst would be rate cuts getting pushed out to 2025. I don't actually think that that's going to happen. I think we are going to see rate cuts this year. I think we're probably going to see 1, maybe 2 rate cuts this year. I think rates are going to come down. Economic data is starting to show some signs of cooling down. We've talked about this a lot recently, but let's refresh that. Look at job openings, right? I've been pointing out this chart a lot. Job openings are coming down lower. We did have a hot NFP print on the last one, but Jerome Powell in his press conference mentioned that he thinks that those, might be a little overstated. I'm paraphrasing, but he mentioned that this number might have been a little overstated, that it might have come in a little out of kind of an outlier position. So what he thinks is, labor data seems to be cooling across the board. Unemployment claims are rising, job openings falling, right? Unemployment rate trickling higher. Wage growth, kind of still in the 4s, but on the lower end of the 4s, not quite the 4.8 that we saw in terms of average hourly earnings year over year. So wage growth, right? So I'm keeping an eye on all this data, but it is important to me that we continue to see cooling economic data in order for me to continue to stay bullish on gold. If something changes, if the economy, if we get retail sales this week that's super hot, and we get PMIs that start coming in strong, and we get, indicators here that tell me that the economy is not slowing, then I need to close out of my gold position, because my thesis for gold longs is about 10% price action and 90% fundamentals. So it's got to stay the course. We've got to continue to see labor data coming in cool. We've got to see the economy showing some signs of slowing down for me to stay long gold, because those are the recipes for a rate cut and a potential slowdown in the economy. So both of those scenarios I like for gold longs. That is why I'm staying bullish gold for now. Like I said, if it breaks the lows, my idea, wrong, and I'm out.
Market analysis, free trading courses, edge finder data, and special offers. What do these things all have in common? They're all available for you right now inside of our free Discord. You can click the link down in the description below to join the free Discord today and get access to all of this and more. Stay up to date with all the latest trading information and A1 content. And if you want to upgrade to our Gold VIP Discord that features every single trade that Trader Nick and our other professional analysts take, you can find the links for that in the description as well. So don't wait, go check out the free Discord today.
We don't trade news like this, Mohammed. Euro USD, Empire State Manufacturing Index, sell or buy. Nobody knows here in the chat what's going to happen with the euro based on the Empire State Manufacturing Index, because we don't have the data. I can tell you that if you're looking at the euro will move probably if the dollar is real strong, meaning this Empire State Manufacturing Index comes out better than expected. The euro dollar is probably going to move lower on a stronger dollar, but we don't know whether that comes out stronger or weaker. So it could be the opposite. Economic data shows more weakness from the Empire State Manufacturing. If that happens, then the euro dollar is going to move higher. We don't know before the news what's going to happen. And I don't pretend to know that or have some sort of secret weapon that I want to sell you guys on a huge course. Like, I don't know what the economic data is going to come out, but reacting to it is very powerful. So don't go anywhere after this spike. A lot of times people will come for the spike and they'll leave right after. Please don't do that, because I'm telling you, more value on these streams happens after the news comes out than before it, because we're not here gambling on what the spike is going to do. If there is going to be a spike, there might not be. If the data comes out exactly or very close to anticipated, the markets won't move that much. It's all about surprise when you're trying to understand the fundamentals. You need to understand it's about how much does the data surprise, not just what is the data, right? Because the market thinks it's going to come in around this. We'll see if the market's right. We got a minute and a half to go here, guys. So stay tuned with me here. We're going to switch over to the all markets view, just so we can get a look at everything on one screen. So just a little bit of context. You've got the S&P 500 here. I've got the NASDAQ here, the Dow, the dollar, the pound, the euro, gold, and oil. So whether you trade currencies or indices or gold or whatever, I've got a lot of different charts up here for you, just so you can keep an eye on how the whole market's responding to this data. We're coming in about 1 minute to go. If you're enjoying the stream, do me a big favor, hit that thumbs up button, hit the subscribe button, all that good stuff. I really appreciate just the support on the channel. And yeah, so should be good. Again, don't go anywhere after the spike. A lot of people will leave, but I'm telling you, the real action comes after the spike, because that's when you get setups. That's when you actually can make decisions off of charts. So yeah, we will see. Pound and euro moving slightly higher ahead of the event. We've got 20 seconds to go. Let's see what happens here, and then we'll break down the data, see what it says. Can't do breaking news today. I'm running without an editor in the booth right now, so no breaking news. Pretend there's a breaking news. We've got 5 seconds to go here. All right, let's see. Empire State Manufacturing Index should be out. Pending. Let's see. Again, waiting for the data to hit. All right, it actually came in better than anticipated. The minus 12.5 that we were expecting actually came in at -6. You can see a mild reaction here to the data, nothing crazy. Gold is still just sitting around where it was pre-news, and the S&P 500, same thing, NASDAQ, same thing, Euro, not making a huge move. So not a huge amount of volatility this morning off of this event so far, though it could, let's break down what this told us. So again, the Empire State Manufacturing Index was expected to show some contraction. We did see contraction. This is a negative number, but it was lesser so than what was forecasted by a pretty good margin. Not a massive margin, but worth mentioning. So what this shows us is, again, the manufacturing index came in better than anticipated. So just slightly better than expected economic print here this morning, which may offer a little bit of strength to the dollar, but clearly it's not really moving the markets that much this morning. Remember that what gets the markets to move substantially is an incredible, difference from expectation. That being said, we've got the Dow Jones here trading lower. The Dow has been really weak this last few weeks, really. S&P 500 trading flat on the day. NASDAQ, same thing. So not too much volatility. Oil is moving higher here pre-market, which is interesting. And let's switch back over to our individual charts here for a second. Also, I wanted to mention about this week, we have some really big stuff coming. This week, one of the really important variables to me actually happens tomorrow. I'm going to be watching really close this retail sales data that comes out tomorrow, because retail sales, here's the thing. We're seeing a slowdown in the labor market. We're seeing some slowdown moderately in inflation. But the question is the consumer going to stay strong, or are they going to wash up too? That's the question, because if the retail sales number comes in tomorrow week, I really think that could cause the stock market to have a little bit of a blip lower. Because if you start to see retail sales, you start to see the consumer crack a little bit more. If that happens, the stock market may pull back for a little bit. That would be my thought. So tomorrow's retail sales numbers are going to be really important. This morning's number, it's important. It does have some merit to the market, but I think your retail sales number is the big one this week. And then we have a bunch of PMIs on Friday, which will also be important to the market. So claims will also, of course, be important as always. So we've got a pretty busy week and should be big. Rate cuts aren't coming so quickly. That might strengthen the dollar, but it also might strengthen the Swiss franc more, just off of the idea that markets may have a little bit of a hiccup going forward. That's also why I'm long gold, right? So I'm sort of oriented towards risk off, which is somewhat contrarian to this market right now. I mean, if you take a look at the NASDAQ, that doesn't look very risk off right now. And so I'm not shorting the NASDAQ, but I am thinking, and this is my take right now, is that going forward, let's say 1 month from now, and again, I could be wrong on this, but this is my thesis. 1 month from now, do I want to be holding the NASDAQ between now and then, or do I want to hold gold between now and then? And for me right now, the answer is gold, because I think gold, relative to the NASDAQ, from just strictly a price action perspective, I think is a better pullback setup currently. But also, I think that the NASDAQ is starting to get a little stretched here. I think that you are starting to see some overbought readings coming into this, and that does not mean that I start shorting the NASDAQ, but it may mean that I'm a little bit more cash heavy. It may mean that I'm trading commodities more. It may mean that I'm selling covered calls, which I have chosen to do against my my indices positions. I am long as of the April lows. I have been holding some trades on those for some time. I'll show you that. In fact, give me a second. So I am long the S&P 500. I have 400 shares of VOO and 1,000 shares of XLK. But I've sold calls against my position, which I was a little early in doing so. But that's kind of where I'm at. I think that the stock market, it's not that I think the stock market doesn't have upside. It's that I think that in the short term, it's a little bit stretched. I think it's a little due for a normal corrective pullback. And I will be looking to kind of just wait on the sidelines for that. I'm still bullish overall on things like the NASDAQ. If you get pullbacks to these levels, I'm probably a buyer. I like both those levels for continuing to stay bullish. But at current levels, it's hard for me to justify really buying anything. Same thing with the S&P 500. If you're looking at this, 53.25 looks a lot better. 52.50 looks a lot better for possibly a bounce trade. But as it stands, I'm just not really seeing the good risk to reward setups buying the NASDAQ and S&P right at the highs. So I'm just waiting for pullbacks if I can get them. Dow Jones, again, this one looks really rough compared to the others. And, if you're wondering, why is the Dow Jones performing so poorly in relation to its peers, the NASDAQ and the S&P 500? Well, it's because if you take a look at some of the sectors that, are, well, even some individual stocks, but technology is doing amazing, right? The semiconductors, this is like AMD and NVIDIA and Qualcomm and those types of companies are doing really well. Technology companies and software companies are even bouncing back. Those areas of the market are doing well. But what's not doing so well is, the rest of the market. It's very thin leadership right now. And when I say leadership, I'm talking about companies performing well. It's really technology and then everything else. So if you take a look at, XLC looks good. This is the comm services, Verizon, AT&T's. Those have bounced well. Google right in there. But then if you take a look at staples, they're not quite near at the highs. Take a look at financials. They've kind of gone sideways. Take a look at real estate. Real estate's been flat for a long time. Industrials not doing so well. Utilities not doing so well. Energy doing terribly, right? XLV, this is healthcare, sideways. So you can see that the stock market, as the stock market just rips through the highs, it does make me a little concerned that you see, while that's going on in the NASDAQ, you see all the other areas performing more like this, right? So that divergence makes me a little bit cautious on the stock market. Again, it doesn't mean I'm bearish on the stock market. It just means that I'm not touching it, buying it up here. I went long in this April pullback. That ended up being one of my better trades this year. That and the gold trade that I took in the first few months of the year, first quarter, those are my biggest trades this year for sure. But I've capped my upside. I've sold calls against my positions, and I'm fine with that because I think that we may see some pullbacks going forward. It's only ripping because of the tech industry. Exactly right. Which is, fine. I mean, technology is a really strong play right now. But when you don't see, participation from other areas of the market, it's a little bit concerning. I'll show you another chart. Is it RSP? RSP. So look at this. Here's RSP. This is the equal weighted S&P 500. That basically says that if you took all of the S&P 500's companies and just put equal amounts of money into all of them, that's what this ETF does. And what you can see is that the ETF that equal weights out the S&P 500 is not doing very hot. But then you take a look at the same chart, the S&P 500, which does weight, and it weights towards the biggest companies. You can see that the biggest companies like NVIDIA, Microsoft, Apple are carrying the entire weight of the market because, again, equal weight is flat, but market cap weighting is performing very, very well. So the divergence there is a little bit concerning for me. And I heard recently on CNBC that the RSP and the S&P 500 they're at like their greatest divergence in, I don't know, some long period of time. It has not been this diverged in some time. So that's a little bit concerning to me. I think that will correct over time. And whether that means that the equal weighted S&P 500 catches up, meaning, other areas of the market start to really participate, or heavy, large cap stocks are top heavy and they start to pull back. One of those two scenarios is going to happen. I don't know which one. I think I kind of lean towards the top, the heaviest companies pulling back here a little bit. I think that you do see like NVIDIA's and Apple's pull back at some point. So we'll keep an eye on that. How do you trade currency pairs that have a strong opposite bias in the Commitment of Traders weekly report? Ava, when it comes to the Commitment of Traders report, which we should pull up just to talk about, the Commitment of Traders data is a powerful tool that I use often in the videos and in my trading. But it's not the only thing that I look at, right? The Commitment of Traders data is a bit lagging to a degree. Well, it is lagging. By the time we get it on Friday, it's Tuesday's data that comes out on Friday. So it's not very great for like scalping or for, immediately trading. But knowing, generally speaking, the direction of money flow is a really powerful indicator. That's why we use it. So what I like to see on this is that, look at gold. Gold continues to be the number one proportionally longed position from the non-commercial positioning. That's really bullish for gold. That has been part of my thesis for why I've been bullish gold in the last, big money is long gold. That's a good sign. It doesn't mean that big money is always right. In fact, big money is sometimes wrong. But you have to understand that what's really important to traders is this section down here. because this section will show you on a week over week basis what's been happening in terms of, kind of the change, right? So if you're looking at, US 30, you can see, for example, that they decreased the number of long contracts that they own. And I'm saying they as a placeholder for non-commercial COT positioning, right? So this is big money, hedge funds, mutual funds. They manage a bunch of money. They increased their shorts. So they increased shorts and they decreased longs. That's a really bearish week for the Dow Jones. So that is something to pay attention to. So we look into that. And you know what else we do is we can do all that manually, but this is just one piece of information. It does sometimes bug me, I'll admit, when people will watch the live streams or videos, they'll want COT data to show up on the screen. And then they're like, okay, that's good. I've got all I need to now trade. And the answer is the reality is that that's not a great way to trade, in my opinion. The COT data is like one puzzle piece. Imagine trying to know what the whole puzzle is based on just one single puzzle piece. That's what trading only with COT data does, in my opinion. You're missing something, because it is a little bit lagging data, and it also can be wrong sometimes, and it's not, it's kind of an aggregate overall. So it is useful, but it's a puzzle piece. It's not the entire puzzle. So then we take that into consideration, but you can see it's one column of many columns that we find to be very, very important to an asset or symbol's scoring. When we look at gold right now, gold is getting a bullish reading because when we calculate all the tabs up, we get a nice bullish reading. But it is possible for something to get a 0 on the COT report, meaning it's not really showing a bias when we look at these currencies, but still get a very bearish reading because of the other factors, right? Don't let one, again, a very, very beginner mistake that a lot of people make is they think they found one holy grail indicator like the commitment of traders data. And they're like, look, I've got the secret. But the real power that I've found over the years is that, the COT data, that's great, but don't forget all the other great, powerful indicators that you can use to your advantage. Why just ignore the rest? Why only put your emphasis on one, which can be wrong, and rather combine many together to kind of get a full picture, right? Let's put the full puzzle together to determine what we're looking at, not just one singular piece.
Did you know we do a live trading show Monday through Friday with guests from all over the world? To get notified when we go live, click the bell button next to the subscribe button, or check in at 9:30 a.m. Eastern Time. We have helpful, free content in the description below and on our website, a1trading.com. Thanks for watching today's video, and we'll see you tomorrow.